Hello everyone. So for this briefing, I chose Apple Inc. because it recently re-entered the credit market with a $4.5 billion bond issuance back in May. It's its first major deal since 2023, so the timing caught investors' attention since Apple's balance sheet has been pretty debt neutral for the last few years. This issuance sparked questions about why Apple's borrowing again and how this affects its leverage and whether credit risk has shifted. So my analysis today connects Apple's Bloomberg default risk and credit ratings and recent market context to explain why the credit quality remains so good despite a more active capital strategy. So I'm going to start with the default risk from Bloomberg. So Apple's one-year default probability is just 0.00016%, and its five-year probability is about 0.0045% as of October of 2025. So these are among the lowest in the entire investment grade universe, meaning that Apple's is incredibly stable. So the model attributes Apple's stability to a $3.5 trillion market cap, with moderate volatility of around 32% and a manageable debt load of 101.7 billion. So even after this year's new issuance, default probabilities still remain really flat, showing that markets view Apple's leverage as strategic and not distress driven. So in the short, the default risk suggests virtually zero near-term credit risk, a remarkably steady long-term profile. So it's really showing the strength of Apple's stock. So the credit ratings, as I found from Bloomberg, shows pretty consistent results across all the major agencies. Moody's rates Apple AAA, stable. S&P rates Apple AA+, and Egan-Jones maintains A+ as of June 2025. So all outlooks are really stable, and there have been no downgrades in over a decade. Bloomberg's default risk model maps to IG1 rating, which aligns with the agencies, confirming Apple's status as the very top of investment grade. So the takeaway here is really that credit agencies remain confident in Apple's fundamentals, and they view the firm's capital flexibility and consistent cash generation as ample protection against any leverage increases. So it's really stable. All the firms kind of agree. There's really a consensus that Apple's a really stable company. So market and balance sheet context. So this is just kind of, I want to explain the wider context of why the default risk and the credit ratings are so strong. So to put the data in context, Apple's 2025 bond deal isn't about plugging liquidity gaps, it's about strategic capital management. So the company is returning to debt markets primarily to refinance older maturities and fund buybacks in still low rate environment relative to historic norms. So its operating cash flow remains well above 110 billion annually, meaning it could easily repay its entire debt if it needed to. And the market's attention is focused less on solvency and more on margins and future AI related spending, whether heavy R&D investment could pressure cash balances. But so far that data shows that Apple has maintained ample liquidity and steady margins even as capital expenditure rises, just basically meaning that Apple really, they have the room to pay back this debt if they need to, and they're more future focused and they're not so much focused on keeping everything as liquid as possible. Or they're adding liquidity, but that's not a bad sign. It's not a sign of distress. So to really wrap up, Apple's credit profile remains exceptionally strong. Both Bloomberg's quantitative models and the rating agency assessments show virtually no default risk and stable outlooks, and the market's small uptick in attention reflects issuance timing, not deteriorating fundamentals. In other words, Apple's return to the bond market signals financial confidence, not weakness. So going forward, the key things to watch are AI-related capital spending, margin resilience, and any changes in cash reparation policy. So for now, Apple continues to exemplify really good investment grade quality with unmatched flexibility among US corporations. And just to summarize, Apple's balance sheet remains one of the cleanest in the world. Its story today is less about risk and more about strategic capital optimization. So really, it's a very stable company. They're very smart, they're very future focused, they're leaning a bit more into AI and technology apparatus, and they're truly focused a ton on how they can look forward, and their issuance of this debt isn't them like struggling to repay things. It's more just refinancing old debt and doing buybacks so that they can have more control over their company and their company's future. Here are my sources, predominantly from Bloomberg, also Apple Inc. Investor Relations and their financial statements, and Bloomberg News, Reuters, the Wall Street Journal. I use ChatGPT for some of my slides and putting my notes together. And yes, thank you so much for listening. And that is my analysis of Apple and their Bloomberg data.